So welcome everyone to this webinar organized by the Center for Development Economics and Sustainability at Monash University. To begin with, we would like to acknowledge the traditional custodians of the land on which our 4 Australian campuses stand and pay our respects to their elders, past, present, and emerging. My name is Gaurav Dutt. I'm the Deputy Director of the Center for Development Economics and Sustainability at Monash University, and it's my pleasure to welcome you to this webinar on India. We've been running this series on COVID-19 and beyond since early May, and have had 14 webinars in the series so far. As it turns out, this is actually the second webinar on India. We had the first webinar on India on 14th of May by Ashok Kotwal. Those were the relatively early days, though the lockdown, nationwide lockdown had begun at that time. And Ashok laid out quite a comprehensive account of, what was happening and what his views were in terms of where we were headed, and also comments on the government response up to that time. The immediate trigger for this webinar is, of course, the recent GDP numbers released by the National Statistics Office in India. They were released, as you know, on the 31st of August, so just over 3 weeks ago. And ever since then, actually, they've been making the headlines, as most of you would be aware of. And the basic facts are pretty well known, and I won't bore you with them, except briefly to just mention, just to set the context. I think the numbers have kind of given us a broad picture of the extent of the economic shock. So everybody knows that the economy shrank by about a quarter during the quarter of April to June. Everyone knows this, it is the largest economic contraction amongst G20 countries, and perhaps the largest one for post-independent India. Certainly the largest one since the quarterly data started getting collected since 1996. The broad parameters of the shock are also well known. I think, we all know that except for agriculture, which grew at 3.4%, all other major sectors of the economy contracted, and some of them very sharply. And everybody also knows that private consumption and investment has tanked. They are the mainstay of the economy on the demand side. So, and the economic shock, the picture of the economic shock is, of course, not only limited to the GDP numbers, and there are many other indicators which are also worth noting. And I'll just mention a few without giving details. The employment indicators, largely from the surveys conducted by the CMIE, have been painting a picture of what's happening on the employment situation. Data from indices such as the Index of Industrial Production, the tax collection data, GST collections, and not just GST, the other taxes as well. Withdrawals from the Provident Funds, the EFPO withdrawals, which again, there've been high volumes of that in recent times. Bank credit to industry has stalled. So there, and then beyond that, there's so many stories which I'm sure all those who've been observing the Indian economy are well aware of, painting also a more human side, if you like, to the story of economic decline, recent economic decline. So we've all seen pictures of migrant workers and so on. In what is considered one of the largest reverse urban to rural migrations in independent India. Queues for food rations and people trying to claim their Jan Dhan payments that the government has offered. All kinds of micro and individual stories of disease and death in hospitals. suicides, and many others. So all this really points to a host of questions and issues in terms of where we stand and where we could be and where we should be and what should be done. And we are very lucky to have really a panel, very, very distinguished panel today to share their views on these emerging issues. And the panel has a wealth of policy experience behind them as well. So they're extremely well placed to offer their views. Let me briefly introduce them before moving on to suggesting to them to share their views. So we have, we did not really decide on an order, but let me suggest an order. Maybe we'll begin with Montek Singh Ahluwalia. So Montek, as you know, really needs no introduction to people who have any familiarity with the Indian economy and policy making. So Montek was a Rhodes Scholar from Oxford University. He's best known as one of the chief architects of the Indian economic reforms, and he served as one of India's senior economic policymakers for over 3 decades, and played a crucial role in the country's transition from the so-called licensed Raj to a market-based economy. He was the special secretary to Prime Minister Rajiv Gandhi and VP Singh in the 1980s, and a commerce secretary and a finance secretary in the 1990s. And he took a break then to go to the IMF, joining as its first director of the Independent Evaluation Office. But he returned to India in 2004 and assumed his role as the deputy chairman of the Planning Commission with the rank of a cabinet minister, a position that he held up to May 2014. He was also awarded the Padma Vibhushan by the President of India in 2011 for his outstanding contribution to economic policy and public service. And he has recently written a book, as many of you would be aware of, called Backstage: The Story Behind India's High Growth Years, which is a magnificent sort of chronicle to the entire economic reform process, which was a critical part of the India growth story. Our second guest today is Dr. Prabhup Sen from the International Growth Center, the India office. And Prabhup Sen is he's the director of the IGC India office, and Prabhup received his PhD in economics from the Johns Hopkins University, specializing in open economy, macroeconomic systems, international economics, and public finance. And most recently, he was, as you know, the chairman of the National Statistical Commission, and he was the first chief statistician for India. And he has also been the functional and technical head of the National Statistical System in India, as well as Secretary, Ministry of Statistics and Program Implementation in the Government of India from 2007 to 2010. And he has also had a long career as a principal economic advisor to the Government of India's Planning Commission, so in close association with Montek himself, and playing a key role in the formulation and appraisal of several 5-year plans, including the 8th, 9th, and the 10th plan. And Pranav also has been writing extensively recently on the current COVID-19 shock, including a 5-part article that was published in Ideas for India during over the days June 5th to June 9th. Moving on to our third, last but not the least, Professor Ashima Goyal from the Indira Gandhi Institute for Development Research. Ashima has widely published in the areas of institutional and open economy, macroeconomics, international finance, and governance. And recently, she's also edited this book that is quite well known, The Concise Handbook of the Indian Economy in the 21st Century, published by OUP in 2019, I believe. She edits the Routledge Journal Macroeconomics and Finance in Emerging Market Economies, and has been providing consultancy to many international and national organizations. And she's the recipient of several awards and fellowships, and has been quite active in Indian policy debates, and has served on several government committees and boards of education and financial institutions, including the RBI Technical Advisory Committee for Monetary Policy. And importantly, currently she's a member of the Economic Advisory Council of the Prime Minister, and she also holds positions as an independent director at Edelweiss Financial Services, IDBI, and SBI General Insurance. And she also contributes a column to the Hindu Business Line. So with that introduction, I think it should be evident that we are really quite lucky to have such a distinguished panel. I'll broadly lay out the broad format we are thinking of. This is just a broad format. So we had suggested to our distinguished speakers if they could actually limit their talks to about 10 minutes each, and with the main aim is to leave more room for discussion. We hope to go for about 75 minutes overall. And I think it might be best for me to stop talking. I've been talking for quite a long time, and turn it over to, so we might begin with Montek and follow up by Prabhup and then Ashima. So may I invite Montek for you to share your thoughts on where we stand and what we could, where we could be and how we could get there, to put it in a very, very broad way. Thank you.
Thank you very much, Gaurav, and good afternoon, everybody in Monash. It's a great pleasure to be on this webinar with my good friend Prabhup Sen and also Ashima Goyal. You know, Gaurav had suggested that we organize our remarks in three groups. One, sort of looking at how we got there. B, looking at what's going on and what are the current problems. And then commenting a bit on what are the prospects for the future. And I think Prabhup had suggested that it would be a good idea for each participant to indicate where he disagrees with the other participants so that we can have a more enlightened discussion. This is actually very comforting for me because I haven't heard the others. So I will just try to highlight those aspects of my presentation which potentially they could disagree with, and actually invite them to express their views where they think that I've gone somewhat wrong. So I have limited time, so let me just focus on, get straight down to it. First, on the how do we get here? I think the most important thing to keep in mind is that India didn't hit the COVID crisis running. It was not in good shape when the crisis broke. You know, we went through a period of very high growth in the first 7 years of the UPA, up to about 2010, where average growth rate came to about 8.3%. And this was including the global financial crisis, which we managed to get out of reasonably quickly. And then, of course, the economy slowed down. The UPA was blamed for that and lost the election in 2014. Now, understandably, the NDA under Narendra Modi promised early return to high growth. That was clearly an important aspirational objective and remains so. And actually, they achieved that in the first 3 years. I mean, the economy rebounded quite strongly in the first 3 years of Prime Minister Modi's government. But then it began to slow down after about 2017. And in the last full year before the crisis hit, the lockdown began on March 24, so I guess the last week of that year was a part of the crisis, but the overall growth rate of the economy was down to 4.2%. So India did not get hit by a crisis in a period when it was growing well. It got hit by a crisis in a period when growth had slowed down quarter by quarter over more than 2 years. And I think this is an important issue that we have to address because it raises the question, why did India slow down? Was it, as some people at one stage thought, just the result of episodic events like the demonetization or a somewhat poorly handled GST implementation? Or was it due to more structural weaknesses in the economy which should have been addressed and were not addressed? In my view, I mean, clearly demonetization and the disruption of the GST did contribute, but I think, and the disruption of the GST continues because that's been a problem that requires correction. But I think there were other structural factors which led to the slowdown. And when we talk about recovery, we have to address what those structural factors are. I'll come back to that. Now let's turn to the actual crisis. I think Gaurav has set out the broad dimensions of that, both in terms of what it did to GDP growth and also what it did to employment and impact on poverty and so on. Now, India, like many other countries, introduced a lockdown as the only way of managing a health crisis when you don't have a cure and you don't have a vaccine. Now, obviously, countries have done these things differently. And I think before commenting on how things have gone, it's very important to realize that this crisis is truly exceptional. I mean, this is not your run-of-the-mill crisis where you can see how other countries did it. There is really no parallel. From a health point of view, I guess the Spanish flu, going back to 1918 is a parallel, but the world was very different in those days, much less movement, much less interconnectivity, et cetera, et cetera. So this is an exceptional crisis in which nobody actually has a playbook. And clearly many of the very important larger countries, except for China, seem to have done just as poorly. So how has India done? Well, India introduced what, in fact, it proudly said was the largest, the strictest lockdown of all countries. And not surprisingly, there was a big decline in growth, 24% in the first quarter. But I think the expectation when the lockdown was introduced, this was never actually quantified, but certainly the expectation is that this would be a temporary intervention that would effectively reduce the spread of infection, and we would very quickly get back to growth. I mean, many government spokesmen talked about a quick recovery, a V-shaped recovery, green shoots, et cetera, et cetera. I mean, there have always been other views. As a matter of fact, Prabhup Sen, who's going to follow me, has said that even the 24% is probably an underestimate, but I'll leave that to him to pursue. The fact is that nobody today believes that there will be a V-shaped recovery. I mean, the available micro data for the second quarter, which ends at the end of September, actually show that while this quarter will be better than the first quarter, it will still be short of the level of production of the previous quarter. And when I talk to businessmen, most of them think that they would be lucky if their turnover is something like 20% below what it was in the previous quarter. So that's the second quarter. And I don't think the third quarter will suddenly become positive compared to the previous year. So actually, most businessmen think that the first 3 quarters will show a contraction, big one in the first quarter, significant in the second quarter, something in the third quarter, and maybe by the fourth quarter, compared to the previous year, there may not actually be a contraction. Even that is conditional on what actually happens to the COVID infection. And there, far from being an early impact in terms of reducing the rate of infection, the fact is infections are rising in India. I mean, they've started falling in the United States. New infections have started falling in the United States, falling in Brazil, but they're rising in India. Now, I don't have the technical expertise to pronounce on these things. You really need somebody with a lot of epidemiological knowledge. And I think there are issues of data. I mean, every time you open anything, cross-country comparisons, there are huge comparison issues. But however one resolves that, it's very clear that the COVID disease problem isn't going away very quickly. And that will only delay the recovery because you're going to have possibly reintroductions of lockdowns and so on. There are lots of technical questions about whether the lockdown itself could have been better managed. I mean, should it have been national or more regionally concentrated where the problem is severe? Should it have been introduced with a little bit more consultation and forewarning, or with just a 4-hour advance warning as it was? Should someone have thought about what will happen to the migrant workers working in the informal sector who are going to lose jobs in large quantities, and without income support and without social security and without an assurance of early return to normalcy, they're going to go back. But going back is going to be interrupted by movement restrictions. And that has really been a subject of lots and lots of discussion. So I think all of these things, I hope somebody in the government and indeed outside the government will do a very detailed analysis of what happened so that if we are faced with a similar pandemic in future, we will at least know what we did last time, with some judgment on how we could have done things better. So I won't pronounce on whether we could have managed the health thing better. I mean, you can always manage things better, but I don't know exactly what would be the right thing to do. Perhaps my co-panelists have views on this thing. Let me now turn to the economics, where I'm probably equally ignorant, but I'm more willing to pronounce, because everyone's an expert in economics. And I think here, the big issue has been, should the government have introduced a stronger macroeconomic stimulus to counter the reduction in output? Now, I think on this one, one thing is very clear. The government accepts that there was a need for a counter stimulus, and that's why they introduced this 2 trillion rupee, which is 10% of GDP. But the trick there is that the 2 trillion is not actually expenditure. Most of it, the overwhelming majority of it, is really action on the credit side, restructuring of loans, postponement of payments, extending of loans to businesses in difficulty, et cetera, all of which is very good. But the actual additional expenditure, which is a fiscal stimulus, if you like, is actually quite small. I mean, estimates vary, but people have talked about 1% of GDP, maybe a little more at most. Now, in the whole debate on whether India should have done more, it's obviously anchored on the question of, does India have the fiscal space? And it's obviously useless to compare with the size of the stimulus being given by the United States, which actually is a reserve currency area, etc. India cannot have that luxury. But I think India we can legitimately ask whether the increase in expenditure could have been more. And when I say more, it doesn't have to be a huge amount more, maybe an extra 1% of GDP or 1.5% of GDP. What I think is causing the big problem is that the decline in output, which has occurred, is also going to lead to a huge decline in tax revenues. Now, the government has not actually officially admitted what will be the decline in GDP, which is, I think, unfortunate because it's very clear it's going to be a decline. And the sooner we get a number put on it, the better it will be possible to judge the adequacy of government policy. But you know, most people think that we should expect a decline in tax revenues of something of the order of 2.5% of GDP. And maybe a little extra will come because of the decline in non-tax revenues. Now that is going to lead to an increase in the fiscal deficit by itself. And any increase in expenditure would be over and above that. So the question really is, and second, what are the states going to do? And it's very clear that they're going to be allowed to expand their fiscal deficit also. So the general government deficit, center and states together, which was originally projected at about 6% of GDP, is probably going to be well in excess of 10% of GDP. Now, two issues arise. One, could it be a little bit more? And I think that should not be judged simply in terms of what the current size of the deficit is going to be, for the simple reason that when you have a huge decline in tax revenues and the deficit expands, that's not an expansionary fiscal stimulus. On the contrary, trying to correct it would be a contractionary stimulus. Because, you know, when tax revenues go down because you reduce tax rates as a conscious act, that's expansionary, because money is going from the government to the public. Here, what has happened is the physical lockdown has prevented incomes from being generated, and as a result, tax revenues have fallen. The loss of incomes is leading to a contraction in consumption expenditure. It's also leading to uncertainty about the future, because nobody knows how long this is going to take on, and that will lead to a further contraction in consumption expenditure. And so the idea is that as the lockdown is phased out, which it is being phased out now, you need a recovery of demand, otherwise you just get caught in a very low level equilibrium trap. Now, the usual argument against a big stimulus is that you're crowding out the private sector, which would otherwise have rushed in and done good things. But in the present situation, you can be 100% sure that private investment is not going to respond early. I mean, it's at most going to come back when production gets back to the level it was in 2019-20, which will be sometime in the middle of 2021. I mean, sorry, 21-22. So you're in a situation where the fiscal deficit is going to be high. You can make the point that we should do a little more. One bit of doing a little more is to help the poor. That's a moral compulsion, and quite honestly, that's not a very big amount. I mean, people have talked about an extra 0.75% of GDP or something of that order to take care of the most vulnerable. Then there are other expenditures which are needed. They would certainly include expenditures on the health side, on health infrastructure, and I would even say on more general infrastructure to offset the fact that private investment has collapsed. So this is the issue. Although we're going to have a high fiscal deficit, could we tolerate a little bit more by allowing for additional expenditure for the current year? Obviously, this will lead to a much higher debt to GDP ratio next year, and that has to be taken care of. But I think the solution to that lies in introducing a structured fiscal reform next year so that you bring the debt ratio and fiscal deficit down over time. And you know, one of the biggest factors that will enable you to do that is whether you can expand growth. I mean, reducing the debt ratio by simply contracting expenditure is one thing, but reducing it by generating higher growth is another. And probably we need to consider what needs to be done in that area. So that's really the big issue about the current situation. Despite the high fiscal deficit ratio, does India have the capacity, A, to do a little more for the poor? I think that should not be a controversial matter because that's not very big. B, could it actually expand expenditure in other areas which would offset the decline in private investment? So much then for what is the current issue. Now we come to the future. Now, you know, I think this is, of course, highly uncertain and probably running out of time also. I think we go back a little to ask, what do we think is going to happen? Now, next year, the economy will be reacting to a very depressed position in the current year. So I would say that if the decline in the current year is anything between 7 and 10% of GDP, and you get a rebound of 7% of GDP or a little more next year, you will only get back to where you were in 2019-20. So I wouldn't call that as a recovery of growth. I would call that a recovery of output. And my guess is that unless the COVID situation goes quite out of hand, and we don't really know, but I mean, one can make assumptions that perhaps it will begin to calm down. Some recovery of that kind might happen, but that is not what we should be focusing on. The real question is, what is India's medium-term growth prospect after it has got its output back to a normal level. Now, this is really where one needs to identify why did India slow down. Now, the usual debate is economic reforms. And of course, that's always true. I mean, look, we are at the bottom of the middle income country level. So we have a long way to go. And in that long way to go, there are a lot of reforms that have to be done. Institutional reforms, deeper reform, third generation reform, whatever. I don't think it's very helpful to list all of these because that list is very large. But what is important is, what is it that's most likely in the next 3-4 years to make the biggest difference? Well, I would list the following, and I invite my colleagues also to comment on whether they agree with this prioritization. First, we're going to enter the future with a fiscal situation that is seriously strained. So a credible fiscal correction program over the next 4 to 5 years is going to be very crucial. I think a very large part of this has to come from higher tax revenues and not so much from a reduction in expenditure. We may need to change the composition of expenditure, but the total level of expenditure in India is not that high. On the other hand, most people think that at our level of income, we should be generating about 6 percentage points of GDP more in terms of tax revenues. And I think what we need is to outline a credible program of reform, which would essentially persuade, which would A, carry credibility in markets, and would put us on the path of raising the tax revenue to GDP ratio. I've mentioned this in my book Backstage, and Gaurav, thank you for the advertisement. Let me complete the advertisement by just showing a picture of the book. So I think those of you who are interested in the Indian economy really ought to go and get a copy of the book. So I won't repeat what I've said there, but I have said that we should put in place a very high level consultative expert committee that outlines what needs to be done in the area of taxation and tax administration, which would A, fix the problems that we have with GST, which are festering, and that needs to be addressed. Put in place the kind of tax administration that will ensure less hassles for investors. That's a big complaint, both of domestic investors and foreign investors. And you know, in some of the new areas, particularly the digital economy, we need to evolve a tax system that will live up to current international expectations of what is the right thing to do. So I think that's one area. The second very urgent area, in my view, is fixing the financial system. I mean, I think we have to recognize that the banking system is in deep trouble. Now, you know, everything becomes political, and whenever this is mentioned, people say that, look, all these problems arose because of the boom years in the UPA when the banks lent all over the place. I think it's true in every society that all boom years lead to excess bank lending. And then, you know, you hit a block and then you do something about it. Now, without getting into the politics of it, the fact that NPAs had built up became known in 2015. And, you know, I think that one of the reasons why the economy slowed down in 2017 onwards under the NDA, after having recovered initially, was that no credible steps in deeper banking reforms were put forward. You know, I don't regard merger of good banks with bad banks as a reform. I think we have to address the issue of, are we going to reduce the role of the government in public sector banks? There are many formulae short of complete privatization. I won't go into them, but I think that's something we need to address. Most importantly, I think, is we need to amend the law so that we can reduce the government equity in public sector banks below 50%. I mean, that I think is absolutely essential, because the 50% rule imposes all kinds of restrictions on public sector banks, which are simply not consistent with imaginative risk-taking lending. Third, we need to give the RBI the same power over public sector banks that it has over private sector banks. That is not the case at the moment. I mean, the RBI can remove a chairman of a private sector bank for not being fit and proper. Can't do that with public sector banks. I think if we want to build a credible monetary authority, a level playing field between the public sector banks and the private sector banks is absolutely essential. Now, you know, there are a whole slew of other reforms, accelerating privatization. Government has said it will do it, but hasn't actually done anything so far. And typically what happens is that one public sector enterprise buys another public sector enterprise. That's not what I call privatization. If we are convinced that we want to privatize, and that's what the government says, then I think that we should have genuine privatization. The problem here is that, you know, if the bureaucracy is not actually keen on it, it's very easy for them to set up rules where, for example, no bid will be acceptable. If you've got a public sector organization that is saddled with impossible debts, the only way it will be privatized is the government recognizes that these debts were built up under its management and takes on the burden itself, and then counts on a competitive bid to get the best price. So unless things like this are aggressively followed, you really won't get any significant movement on privatization. So I think, and I mean, by the way, there's a list of other reforms, but this is a big enough list. I think if in the next 3 years or so, a credible program is set out, that we're going to make progress in this, I think we could do a lot better. I think finally, I think it's very important. You know, there is a creeping tendency for protectionism to return, which is now led by the leading countries in the world. I mean, India is not the only country that's being pushed into protectionism. The signals coming from the major economies are also protectionist. Well, you know, they're rich, they can afford it, they can afford to lose growth for a few years. We can't. So I think this is a second, I mean, the government, by the way, while it has talked about Atmanirbhar, which is broadly called self-reliance or self-esteem, has also said that we don't want to be become insulated, that this is a way, we should also integrate with global supply chains, which is good. But the logic of that is that we cannot have a protectionist increase in duties. So I think that this is an unresolved issue, and to my mind, we need much greater clarity and from the advisors of the government who can advise the government on how to achieve its own objective of integrating with global supply chain. That's a very good objective in my view, because it will prevent people from rushing in with the wrong kind of policies. So that's roughly what the issues. I think there's enough there to discuss and disagree with. I'll stop at that point. Thank you, Gaurav.
Well, thanks a lot, Montek. A lot to chew on there, so thank you very much. I mean, you know, this is a bit like the Indian reform process. I think I'm going to make a course correction here in terms of our format. I think we had initially thought that we'll stick to about 10 minutes each. So I think it's more important to have a good discussion and let people have the opportunity to you know, clarify and explain their views and perspectives. So rather than be slave to some, you know, rule of 10 minutes. So I think, you know, we'll still try to keep roughly within the time. We might go a little bit over time. So I'm not insisting on a 10-minute rule, but try to keep it short so that we leave some time for discussion. With that, let me invite Dr. Sen to perhaps give his own views and maybe even respond to some of the things that Montek has talked about.
You're lucky, Gaurav, because by and large, I think Montek has described the past rather well, and there's very little that one can add to that, so I will not even bother trying, except for a couple of points that I think he should have made, which is he talked about the slowdown of the Indian economy from 2017-18 onwards, so that we were slowing down even before we got to the COVID incident. What he should have pointed out is that given the nature of our national account system, this slowdown was in corporate India. There was damage going on in non-corporate, but this is where corporate India went down. Now, the implication of that is that the overall level of confidence in the corporate sector was already seriously down. So if you look at what was happening to corporate investments, for instance, our investment rate, which at one time had peaked at 37%, is now down to only 27% of GDP. And much of it is because of corporate India. And this really becomes important when I start talking about Montague's suggestion about the future. The second point is that as far as the COVID, the reaction to COVID is concerned, the lockdown, I think epidemiologists in India have been clear right from day one, is that we were doing this to delay the onset and peak of the disease. But somehow the impression gained ground in India that if you lock down for 40 days, COVID would miraculously disappear, which it didn't. And that has very strong psychological effects, and I will just come to that. So, but what it did do, the 40 plus days lockdown that we had, what it did do is it enabled us to ramp up what we simply didn't have earlier. For instance, masks were not available, personal protection equipment was not available, ventilators were not available, intensive care unit beds were not available. A lot of these have been now sort of brought into place. We are exporting some of them, in fact. Now, this was important and it was needed. The point is that after the lockdown was lifted and the COVID cases started rising almost exponentially, I think the feeling that people have got is that the government's lockdown didn't quite achieve its purpose. And there is going to be the possibility of another lockdown. Now, this uncertainty needs to be allayed as soon as possible, because so long as it is there, behaviorally, both consumers and investors are going to be holding back. They're going to be expecting another shock, and this is happening at the moment. Now, this is a particularly difficult issue to handle, because my sense is that the real problem that we're facing today is a complete lack of confidence in both the consumers and the investors. And unless this is addressed and addressed up front, it's going to be a problem. But let me come to the point that Montague was making, which is in terms of fiscal stimulus. The government has just very recently done what's called a supplementary demand for grants, which is asking for additional money for central government expenditures. And if that is anything to go by, the fiscal stimulus is actually pretty small. It's less than 0.8% of GDP, of last year's GDP. This year's GDP, of course, it will look a lot higher. So as far as a fiscal stimulus is concerned, there isn't much there at all. But the loss in taxes is significant. My personal reading is that between center and states, if things go as they are going now, we are probably looking at something like 3.5 to 4% of GDP. So, and as Montague said, that's not a fiscal stimulus in any sense of the word. But what it does do is it makes life extremely difficult for state governments. Now, if you think about the state governments, they are bearing at the moment the brunt of the disease management and the humanitarian assistance costs. And the state government's tax resources, if anything, are going to be impacted more than of the center. Now, in a situation of that kind, the states have a serious problem in financing what they need to do. Now, this in and of itself wouldn't have been a problem. But of late, what we have seen is a very unseemly face-off between the states and the center regarding sharing of burdens. And that, I think, was undesirable. I think it sends out the wrong message. And in an important sense, I think it sends out the message that the center isn't really very serious about an additional fiscal stimulus, because anybody who knows the Indian economic system knows that the center has the money, but it doesn't have the institutional reach to do a lot of the kinds of things that need to be done. That institutional and physical reach is there only in the state governments. Now, because of that, if the impression gets around that the center and states are at loggerheads, the center is, in a sense, washing its hands of all responsibility and essentially putting the burden on the states, it doesn't help confidence one bit. And I think that's a part of the problem that we are coming into at the moment. Let me then finally come to the issue about the financial sector. I think everybody is in agreement that the financial sector is in deep trouble. It was in trouble earlier, before COVID happened, and now it's in much worse trouble. However, I think the Reserve Bank of India in this particular instance moved very quickly, and what they did in terms of giving a moratorium on loan repayment and so on. The government has also moved by delaying the process of recognition of non-performing loans. So all of that is to the good, because what it does is it pushes back the day of reckoning. But the day of reckoning is already here. Most of this ended as of 1st September. And now the Reserve Bank has been asking the banks to restructure what they consider to be viable loans. And the banks across the board uniformly are very clear that they are going to be extremely selective about which loans are going to be rescheduled. And I suspect that these will only be their best clients. So we are talking about something like a quarter of the loans will probably be restructured, which leaves a rather large quantum of loans which are not going to be restructured. And given the fact that the economy is not going great guns at the moment, a very large number of these are going to be turning NPL very, very quickly. Now, when it does, then we are looking at a very uncomfortable situation where the economy runs the risk of actually transiting directly from a severe demand constraint to a supply constraint. And as all of us in economics know, addressing a demand constraint is relatively easy. Addressing supply constraints isn't. So all the things that Montague talked about in terms of reforms are the sort of things governments do to talk up the economy for the supply response to come. But the point is, before all of that works, there has to be an improvement in the overall sentiments and confidence in the investor community. That's not going to happen in a hurry. Today, the capacity utilization in Indian industry is at an all-time low. And take it from me, no serious investment is going to happen until this capacity utilization level goes to something above 80%, closer to 85%. That used to be our trigger that we used to consider for turning of the investment cycle. That's a long way off. That's about 25%. So recovery of investment, I'm afraid, is going to be a slow process. And in this context, this is where the whole question is going to arise. And this is where I would tend to disagree slightly with Monte, is what is the point at which you start doing the tax reforms that he's talking about? Do you do it when you start seeing some recovery in the economy, which would most likely be next year sometime? Or do you wait until you see the investment cycle turning, which can actually take longer? Because if you start too early in that process, then you may nip the investment cycle, in the bud. And that's something that I don't think is particularly desirable. Now, so far as the issue of what is it that the government can do to prevent this from happening and get the recovery momentum back, really, I think there are a couple of things. One is that the actual expenditure is not that important. Expenditure now. What is important, I think, is the assurance that over a longer period of time, not like the next 3 months or next 4 months, but over the next 3 years, that the government is putting in place a committed plan of expenditure to support the growth recovery process. It is the duration of the support that is, I think, more important, particularly when it comes to investments. But to an extent, I think also when it comes to consumers. And that is the plan that is missing. There is talk about immediate responses of some variety, but until and unless you recognize that the recovery process is going to be protracted, and therefore the response should also be protracted and should be announced early so that people have the assurance that the government will be there when they need it. This, unfortunately, is something we have not heard. We've heard of reforms, but we have not heard of support. And I think that is the single largest weakness in the government response to this crisis. Thank you. I'll stop here.
Thank you very much, Pranav, and it's very interesting, and I hope we be able to follow up on some of the points that you make, especially where in relation to the future and this timing of reform measures and so on, which I think are really critical issues. But let me turn to Ashima, who's been patiently waiting and listening, and we are now actually very anxious to hear what you might have, your views on this topics. Thank you, Ashima.
Yeah, I think I'm not the last, but I can respond to what's happened earlier. And then we can have more battles probably. But I think it's a fundamental human trait to blame some other, to find somebody to blame for whatever's happening. And for the pandemic situation, there are many potential targets, but a blame game does not help. It's better to be constructive and look forward. You can't stay in this forever. We have to get out of it sometime. Once the WHO had delayed the announcement of the pandemic, India had very little time to react to try and prevent a spread through the country. I agree with Montek that it was an exceptional situation, very few pointers or So we imposed a countrywide lockdown just a few days after the pandemic announcement. The issue was that India's congestion and poverty made it especially vulnerable. And Indian democracy made partial lockdowns unlikely to work. People would not take things seriously. So none of the frightening, that time epidemiologists had very frightening projections. None of those have materialized so far. The figures are still rising. So the lockdowns did succeed in slowing the spread. They raised awareness and gave time to improve medical preparedness, as I think Montek has said. If India had followed the Brazil do-nothing model, since our population is 6.5 theirs, just multiplying their deaths and cases, our current figures we would have 25,000 deaths and 28 million cases compared to about 88,000 deaths we have now and 5.5 million cases. So, you know, saving deaths, you give up some income. I think it is an acceptable trade-off. The initial policy response was to supply food because of, I mean, there is a large section of people who would lose their jobs, the vulnerable, to improve medical supplies, and moratorium on loans and other regulatory compliance. And I think it is we should mark this success, since there are very few sort of positives now. But the power of democracy and media was such that there were no hunger deaths. Unlike the Bengal famine under the British rule, India has come a long way. All the migrants were provided food. You talk to them, they say they were not angry with the government. They said the government has given us food at least. You know, one of the reasons there's not. So they realized that it is a very difficult situation. NGOs also played a tremendous role. I think this corporate social responsibility, which the UPA enacted, is a very, very positive thing for India. As it is, we had a lot of NGOs. Now we had so many people who were intervening and who were doing things for those who were in trouble. But the congested living conditions and no jobs was something that was very difficult to deal with, given that, you know, and given the protracted lockdowns, 20 days is not enough, it had to be extended, etc. Then moreover, we have a very active media. So media hyperbole fanned restlessness, saying, you know, endless lockdowns. And that triggered a panic reverse migration that carried the disease to every corner of the country. The idea of imposing a sudden lockdown was to prevent this spread. But, you know, when they voted with their feet, you could not stop it. So then the question is, could policy have reduced the income loss? Since all non-essential activities were stopped until end May, that is 2 months out of the quarter, the April-June contraction had to be severe. You know, now everybody's saying that in the G20, India is the worst, but recently figures have come out for South Africa that had a lockdown all 3 months and a very strict lockdown. In fact, their lockdown extended for 6 months and has just been relieved somewhat. So their quarter, that Q1 GDP contraction is 51% quarter on quarter. So I think much of the GDP loss we had was due to these activities, all non-essential activities just freezing. And another interesting statistic is that during the supply bottlenecks exceeded the fall in demand. Q1 fall in consumption at 26.7% was less than that in manufacturing, which was minus 39.3. And of course, services demand had largely disappeared. So a demand stimulus would not have helped in that quarter. You know, there were multiple packages the government announced. Among those was a direct benefit transfer to poor women, although it was a small amount, not adequate. But even that inadequate amount was saved, it was not spent. People were not going to spend. There was such fear and sort of precautionary saving. Now, advanced economies spent about 20 to 30% of their GDP in what they called rescue. It was not even recovery, and an equivalent future is planned for recovery. But if emerging markets governments were to borrow that much, the cost of borrowing would rise. If they monetize that much, then inflation, as it is, inflation is not disappeared. Country and currency risk would rise. You know, Professor Walter had this interesting suggestion that since emerging markets suffer volatile flows because of the advanced economy QE, and they cannot do QE themselves because markets won't lend to them at low rates. So then if advanced economies are doing QE, a part of this should be made available to lower income countries. But this is not going to happen. So therefore, emerging markets have to spend what they can. And therefore, they have to spend carefully and where it will be most effective. Now, there is a widespread, I think both Pranav and Montek has said that the government spending is inadequate. But 83% of the full year fiscal deficit was borrowed and spent in that first quarter. And although it is, since revenues had collapsed, spending was more than taxation, which is the positive demand created by the government, although it is not, and they were spending a large amount on medical supplies, etc., etc. Free food grains have been provided until, in the rationing, in the PDS system until November. So the planned FD was around 3.5%. So along with the 1% of extra expenditure announced, it meant that in that quarter, government spent something in addition, about 4%. And the FDA's plan is expected to jump to above 8-10% for the year as a whole. So, and the government share of consumption, which averaged about 18%, rose to 33% in this quarter. So, you know, it is private consumption which has to recover. The government can't do everything itself. Then when you look at the that's the past. In the current situation, since 1st June, we've had series of graded unlocks, they're called. Currently, we are in unlock 4. Now, this puts increasing responsibility on people. In June, when the first unlock allowed factories to resume production, etc., there was a rapid catch-up. But with the reverse migration, the infection started spreading and cases started rising all over India. And the states responded by imposing arbitrary lockdowns, which again disrupted supply chains. So there was a plateauing in July, the catch-up faltered. And in Delhi and Mumbai, we saw that tracing, testing, and along with unlock did bring cases down originally. But by August, there was unlock 3 that allowed freer movement of people, allowed gathering, etc. And this together with COVID fatigue and carelessness led to a very sharp, this current, numbers are rising. In Mumbai on 17 September night, just the next day, my son was going to visit me after 6 months. The Mumbai police imposed section 144. No movement unless you have a permit and etc., etc. And, but the point is that I think, and this Unlock 4 also said that states can't stop interstate movement because now the disease is everywhere. There's no sense in stopping people traveling if they have to on work. So I think we are reaching a situation of more granular unlocks where you do not interrupt supply chains and production. And to Pranav's point about fear and lack of confidence, I think we're seeing so many people. Lonavala, they're reporting 25% occupancy in hotels. People are tired of staying at home. They're going for holidays. Their consumers in India are incorrigible, I think. Some must continue to be scared. But in any case, you need more restrictions on large gathering and movement. And this will probably allow some economic recovery. So the manufacturing PMI is in expansion mode in August. It reached to above 52. Analysts have a range of figures, but they're saying that the catch-up compared to by September, I've seen figures ranging from 80% of last year to 100% activity levels and mobility compared to pre-COVID. Of course, services, people are not, hotels, tourism, travel, all that is going to be highly negatively affected, but there are other sectors which are doing well, such as edutech and digital and home services and pharma, that are doing better, fast-moving consumer goods. So it's not that everything is down and is less than what it was earlier. In unemployment, the CMI figures showed a fall to 23.5% in May, which is what the GDP numbers reflect. But this had recovered in July to 7.4%. Some rise in August, but again in September it is falling. And here I disagree with both Montek and I think Pranav that among the major sort of stimuli this government has used is through the credit system. And I think that in India, Montek made the point that the financial system is in a very bad state, the NPAs, etc. And it is, yes, I agree, but it has been in that state for 10 years now. And we've had a series of reforms. Now, when the rest of the world was doing QE in India, credit growth had fallen. It was absolutely, I think in 2019, it was half of what it was in 2018, and we had that slowdown. So therefore, things were ready enough. The IBC banks had recovered, NPAs had come down to single digits. The recapitalization had to wait for the IBC because otherwise the money would go to promoters. So all this, enough reform had been done that now the banks, it was ready. We were ready for a credit turnaround. You know, in advanced countries, we have there's huge debt increase and all through this last decade, the QE period. India, nothing of that sort. So firms as well as individuals were deleveraging. So we are ready now to have a credit financed push. And we are seeing that, you know, after 2018, there was both, after ILFS, there was both aggregate liquidity tightening as well as sectoral. There was no liquidity window provided to NBFCs. So consumption growth just fell, and that explains that sharp downturn in growth you saw in this period. And again, I disagree that we were in a bad position and therefore things got worse with COVID. There were signs, if you look at high frequency data in February, there were signs of recovery because as liquidity was created in 2019 with the new governor, and we saw recovery there. And it was in March when COVID and the lockdown that is why for that quarter as a whole, the rate of growth was lower. But if you look at the month by month, there was recovery in February. So in the same way with increasing liquidity and credit, although credit growth is low, but you know, the other thing is because of the corporate failures, which was partly due to absence of liquidity, there was huge risk aversion in lending to firms. So again, this government program which gives a warranty to banks. So it's not us, it's not pushing the future NPAs on banks, the government is warranting it. And this has led to more than 1.5 trillion rupees loans going to SMEs and so on. So credit is increasing, and moreover, there is a revival in the corporate bond market. Large amount of money has been raised there. So after external shocks, normally if human capital is intact, there is a V-shaped recovery. But in this case, because of the virus and uncertainty about how long it's going to last, we don't know. But there's some latest research which shows that in this area, the East generally, there's some more immunity, genetic resistance, etc., etc. And I think the fear is less, and as long as there are no total lockdowns, there will be some recovery of consumption and growth. That's the current situation. Prospective, I think the government has promised, I agree with Pranav, that you need a sequence, you need the duration of support. So the government has promised multiple packages. They've already done 2-3, but more are in the pipeline. And the point is that you need to do it when it will be most effective because you don't have too much money to spend. But an announcement is difficult because of the uncertainties. And then the restructuring of loans, which will help firms survive in this period. Again, when you talk to bankers, some analysts are coming up with, Pranav gave some very frightening figures about the percentage that will need restructuring. But when I talk to bankers, like SBI is saying that they think only 5% of it. They say that the people have surplus, they're hoarding liquidity. They have money in their accounts to repay, but they opted for the moratorium. But then as they realized the interest would hit, they started repaying. So, but I agree that there's a huge income loss, a fall in demand, which is cumulative. The people don't spend, it hurts industry. But so therefore, a demand stimulus, and at this stage, since supply chains have recovered somewhat, moreover, we have the festival season where firms are looking for consumers will start spending. But I think that this is a right time to give a, say, 2% of GDP demand stimulus, which could be distributed between, these are my own, let me say that even if I'm on the advisory committee, all this is my own opinion. Government gets a lot of advice, and what they decide to do is ultimately their decision. But my view that this stimulus boost should be spread among the vulnerable sections. Employment subsidy to SMEs, because only 10% of SMEs benefit from the credit, get loans from banks. So to all those SMEs who are registered with GST, because here also I disagree with a lot of the analysis that says we've been suffering since demonetization because the informal sector has been destroyed. I don't think it's been, maybe some firms have been destroyed, but others, we have to move to formalization at some stage. And with fintechs, and if they're registered in GST and their balance sheet data is available, there are people who are lending based on their cash flows. So you're moving towards more formalization. So employment subsidy to SMEs. So we are very careful now that you don't burden the financial system by just helping zombie firms or those that are unlikely to survive. So firms that were, this restructuring also is only to be given to firms which were viable before COVID hit, and therefore have a chance of reviving after the situation becomes normal. So I would like to emphasize that we have learned over the last 10 years. It's not that we are doing the same thing. There's been a lot of financial sector reform, and although the financial sector is being used again to support, in a way this is sensible, because when you don't have money, then this is a future liability, which may or may not materialize depending on how good the recovery is. So the government does not have to borrow today, but it can support firms. And to the extent there's recovery, this warranty will not materialize. And therefore, it's a good way to use limited space available. Then the other, my favorite schemes are some kind of urban MG Nariga for migrant labor who are coming back now, some insurance for them. And this could be as a CSS, financed totally by the center and directly to urban bodies. The states don't devolve to urban bodies either. And then spending on infrastructure, because the other thing is that the demand categories I would support would be those that improve the supply side, because we tend to have inflation. If there's also action supply side, then it is less likely to be inflationary in the future. So I think that there are some positives, such as there is a lot of resilience. If you talk to the average, people want to fight, they want to get back. And there's some substitution in production and consumption. Everything has not dissipated. I was pleased to see one of the things in the 2018 collapse was consumer demand, durable demand just collapsed, cars, everything. We're seeing a revival in this. Why? Because once more NBFCs have liquidity, they're lending to consumers and they are buying. So there's a 40% rise in demand for consumer electronics this August compared to last August, and 20% compared to the last quarter. So it's over last year. And it could be pent up, but it could also be this precautionary saving and people have money to spend as well as credit. So firms have been reducing cost. Analyst projections of margin contraction did not materialize because firms, really they're finding work from home and other digital reduction in resources. And this is going to be more permanent, I think. So SBI has come up that they believe only 5% of their loans will need restructuring. Then I don't know, I must be out of time, but among reforms, I agree with that we need a total fiscal restructuring, and this move towards privatizations, government is committed to that you move from shift. I think our decades of planning left us with a lot of assets in the public sector which are very poorly monetized. So restructure those, release that money and use that money for education, for health, which has spillovers in growth. And I think this government is showing a lot of courage in taking on labor reform and as well as agriculture, the vested interests, the big farmers, the mandis, the commission agents. Those farmers being given options. No government has been able to do this. Is something economists have been saying for so long. And there is a chance that India will attract more supply chains because as international firms realize they need to diversify from China. About protectionism, I'll only say this, that we need to be open. We've learned a lot from this, but the China factor, the huge trade deficits of China. During COVID, we realized that API manufacturing, which we used to do, had all gone to China. That's the active pharmaceutical ingredient. We would not have had medicines if China had been unable to supply us. So some government schemes to bring some of that back here, as well as the border standoff and the consumer, and then security issues worldwide, that these apps, the digital, that there are security issues with that. So we do need some protection there. I think I've disagreed enough. Now I leave it to the others to disagree with me. Yeah.
Thank you very much, Ashima. Yeah, there is, again, a lot of things to perhaps try and hammer through, but I'm very conscious of the time. Actually, we're really up to our planned sort of allocation of time of about 75 minutes. I'm perfectly happy to continue a bit longer if our panel is okay with the idea of continuing a bit longer. Is that fine with Montek and Prabhup and Ashima? Is that fine with you?
I think Montek and Prabhup should reply to some of my criticism.
We can continue a little longer.
Yeah, so let's do that. And I noticed that there are 70 participants who are still with us, which is a good sign that people are still engaged. So we have, of course, also received a number of questions as well. But before I get into that, I think and many of the questions are actually similar to the suggestions and counter-suggestions that have already been made by all of you. So I think in the first instance, perhaps without posing any specific questions, or maybe it would be a good idea to give Montek and Pranav a chance to perhaps respond to potential areas of disagreement. I mean, I think it's heartening to note that Ashima, for all her disagreement, actually mentioned a few things which actually are, in the end, are similar to what Montek and Pranav have been saying, also including you talked about 2% of GDP demand stimulus, which is even more than what perhaps Montek was saying, and similarly on the fiscal restructuring, I think there seems to be some areas of agreement, but let me not second guess. And can I possibly maybe invite Montek first to perhaps respond, or maybe we go in the reverse order this time. Maybe ask Pranav to, if that's okay, Pranav, if you would like to respond first.
Sure.
Yeah.
No, I mean, I do not question the points that Ashima made. The real issue, I think, is that for some reason which I don't quite understand, is that a lot of the discussion that goes on completely ignores the fact that what we have witnessed during April and May is a shock. And it's not part of a business cycle process. It's a significant, large, one-time shock. Now, shocks of this kind always have multiplier effects. And these multiplier effects in the Indian context, of course, I mean, when I had worked on this some time ago, take about a year to year and a half to play out. Now, at least my estimates of the kind of loss that we have suffered between the end of March and the end of June is somewhere between 18 to 20 trillion rupees compared to last year. Now, when you have a shock of that magnitude and you think about multiplier processes, that will take a long time to actually work itself off. The question, of course, is what will be the time path? The expectation is that the time path will be such that in the initial stages, what you are going to get is a lot of pent-up spending happening. The multiplier may look relatively weak, but that just postpones the day of reckoning. It doesn't negate it altogether. And therefore, I think simply tracking what is happening today as being a harbinger of what's going to happen tomorrow and day after, I think is a little dangerous. It may be a harbinger of tomorrow, but it certainly is not a harbinger of what may happen day after. So that's what we need to keep our eyes upon, and to try and figure out how strong and how long these effects can persist. The point that Ashima made, and I completely disagree with, is that the direct benefit transfers that have been going to the households, Ashima has rightly said, a lot of it is getting saved. I wouldn't have expected anything else. That's exactly what I would have expected. But the advantage of that happening, that if the people are saving now, they are actually preventing an increase in precautionary savings later. They are building up their corpus given the level of uncertainty. So what it could lead to, the savings now can actually lead to a weakening of the multiplier later in the year. And that is a good thing. So in fact, rebuilding people's savings through direct benefit transfers is certainly not something that we should run down, particularly when a lot of these transfers went at a time when the supply side was locked down. There could not be a supply response. At that time, if it had actually gone into consumption, then we may have seen higher inflation. The third point I'd like to make, and this again touches on this issue of inflation, is what we are seeing in India is actually quite strange. So if you look at what is happening to the savers today are facing negative interest rates in India. The inflation rate is close to 7%, and the deposit rates in banks, or the yields on most instruments, have actually come down dramatically. In banks, the average interest rate is now near 3%. So they're looking at massive negative interest rates for their savers. But on the other hand, if you look at the producers, what the wholesale price index is saying, it's been in the negative territory for 4 months and has barely crossed into positive territory. It's 0.6% last month. So what it's saying is that the real interest rate for investors is almost at an all-time high. So you're looking at the inflation story from two different perspectives, and they're telling you giving you two different messages. And the point is you have to react to both. You cannot say I will react to one and not the other. Unfortunately, we have a situation where the RBI, because of the legal changes to the RBI Act, is committed to look only at the consumer price index. So it leaves it entirely up to the government to address the deflation that is happening on the producer side. And unless these two are tackled simultaneously, we are not going to be able to get over this problem.
Thank you, Prabhup. Montek, did you want to jump in?
Hi, can I be heard?
Yes, you can.
Okay. Well, thank you, Gaurav, as you say, for giving me an opportunity to jump in. You know, I think, as you said, there's actually more agreement amongst us than might be thought. I can see that Ashima, being on the Prime Minister's Advisory Council may not want an assertion that there's a lot of agreement, so that's okay, Ashima. You know, there are just 2 points that I'd like to make. One, when Prabhup said, you know, that this is not the time to do tax reform, maybe I didn't make my concerns clearer. My concern it was that it's quite clear that we have, as everybody agrees, a very strained fiscal situation. And if we do what we want, and Ashima's suggestion that she wants an extra 2% of GDP fits in with what I said, because I said little less than 1% for the poor. And I was hoping that we'd have something on infrastructure if it's possible. So we don't actually disagree with that. But you know, even if that happens, there is no way that beginning next year, if we are to plan for growth, a revival of growth, you will have to have a credible plan for fiscal restructuring. And my point was that I think in India, that plan has to be by raising revenues, because I think our revenue system is not generating the revenues it should, without talking about tax rates. Although I think in the GST, there's need for some fiddling with tax rates too. I was not at all suggesting, by the way, that we do it now. In fact, what I had suggested was set up a high-level committee which goes through a very extensive consultation process and outlines a multi-year program for tax reform, which can then be discussed, which can persuade investors and others that, look, this is the way to go. And whether you implement it at the next budget or even maybe in the budget of 2019, 23, 24, that's a separate issue, because I do not believe that this kind of tax reform will emerge simply from the finance ministry. I mean, I mentioned in my book Backstage that, you know, in 1991, Dr. Manmohan Singh had to set up a high-level committee outside government headed by Raja Chellaya. And they put out a comprehensive program of reform, and that I think is what we need right now, especially since the whole issue of taxation of the digital economy, including this cross-border taxation of e-commerce companies and companies in this space, is potentially something that should be done within a framework of global consensus. So it's a big agenda. We ought to recognize the agenda, prepare ourselves for it. I'm very glad to hear Ashima say that, you know, integration with global supply chains still remains on the agenda. And our real concern is actually with China. Now, you know, she's right that the active pharmaceutical ingredients production got phased out of India. How much of that was just because of competitiveness on the part of China? And how much of that was simply us not recognizing that these areas require a lot of support, including on issues of environment and so on, is an open question. Because this phasing out happened long before COVID. I mean, it happened over the last 10 years or so. So I'm in favor of redefining Atmanirbhar to say that, look, we define certain areas where we want to be internationally competitive, and we identify all the things the government needs to do to make these sectors competitive, and the government outlines a program that is going to do it. I mean, this is sort of a little bit like making clear what expenditures the government is going to incur over the next 4 or 5 years. I mean, to some extent, you know, the absence of 5-year plans means that we no longer have a coherent system of judging government expenditures over a 5-year period. I mean, every ministry can announce programs and nobody judges whether they all add up to a fiscally sustainable total. Now, if you just look at the macro side, if you want to reduce the fiscal deficit, let's say over a 4 or 5 year period, by something like 4% of GDP or even 5% of GDP, which is what people would expect because we're running a very, very high fiscal deficit. And you have to have some increase in expenditure, which I think we do need, certainly in health, certainly in research and development, certainly in critical infrastructure. Then you got 5% plus maybe an additional 2.5% on these kinds of expenditures. So you need a 7.5% fiscal turnaround. And some of that can come from weeding out existing expenditures, although that can create a huge political storm. And the rest has to come from taxation. Now, if you don't do anything about this, then you're going to have one of two things. You'll either be hiding the fiscal deficit, which we are quite good at and have been for many, many years, or basically you'll be having investors and rating agencies say, India is now going way out of its fiscal space. So somewhere you have to come to terms with this. And I think that requires a 3-year horizon. I mean, I agree with what Prabhup said, that we need to recognize that we'll still be tottering next year. You know, you must remember, I don't know, Ashima, if I'm misquoting you, but you were quoted in the newspapers at one time as saying that you thought that the current GDP, this year's GDP, would range between -1% and +3%. Fair enough. I mean, this was a couple of months ago. There were uncertainties and so on. If you look at what most people would say today, I mean, they would say something like -7 to maybe -11%. All right, maybe the -11 is too much. But you know, if it's -10, are we going to have a +10% on this base next year? Or as Prabhup says, is it going to spill over? So it'll happen, but it won't happen that fast. So I think on the whole, we need a recognition that we are in a tough spot and we need to get something better. You know, I agree with Ashima that what the RBI has done on credit is very good. I mean, I think they've actually insulated everybody from the first year of the shock. And now it's time to decide who's actually viable and who's not viable. But the critical issue that I think remains unresolved, and this is not a criticism of this particular government, this is a criticism of the political system. I think at the moment, there seems to be no political willingness to accept that the government share of bank equity must go below 50%, okay? And you know, there's a serious question whether if that is a constraint, are you ever going to get the banks, public sector banks, functioning efficiently? Or will you be pushed into constant regulatory relaxation for them, which is what Urjit Patel is complaining about in his book, Overdraft. And you know, finally, a last point, and that is inflation. You know, obviously, we'd love to have a reasonable rate of inflation, but please remember, businessmen love inflation. I mean, all creditors love inflation. And today, the biggest creditor is the government of India. I mean, it owes a huge amount of debt. And historically, I mean, debt to GDP ratios have been reduced either because you have the ability to do such dramatic reform that you unleash phenomenal growth. That's one way of doing it. The other is simply governments never renege on their debt. They just allow inflation to take place, which erodes the debt away. So those who are hoping for moderate rates of inflation ought to be hoping for very dramatic reforms that will jack up the GDP. Otherwise, it's going to be very unlikely that the RBI can use monetary policy to force inflation to reasonable levels. We could go on and on, but I mean, I don't want to strain your audience, but that's my input for the moment.
Well, thank you very much, Montek. No, I feel the same. I think we could go on and on for quite a while, and I hope, I mean, not to, perhaps we won't be able to do it today, but I hope there are occasions for, you know, perhaps these marathon discussions sometimes. I think it's worthwhile, where, you know, it's not, the discussion doesn't end with point to counterpoint, but, you know, there is some cajoling and coaxing other people to really recognize and different points of view. Maybe, I mean, I don't know, maybe time is not the culprit here. There are other issues, but look, I mean, I think we are pretty much out of time, and I have this difficult job of deciding whether we accommodate a couple of questions, or and we have some questions from the audience as well, or try to bring proceedings to a close. Let me actually go for the alternative of putting in, to be fair to the audience, at least accommodate 1 or 2 questions from the audience, and perhaps that gives our speakers also an opportunity perhaps for some final words. So one of the questions actually is quite straightforward, which is a topic which has been mentioned and debated at times, is that, so there's a question from the audience which says, do you think a UBI would have been more beneficial And what is your opinion regarding a universal basic income policy to revive the economy? So that's sort of one. I'll put one or two out there for you to take your pick. The other one talks about, given that there is a severe risk aversion in the financial sector and the private sector has no inclination to invest at this stage, would it be fair to say that the monetary policy has reached its limits? And it may not be a good idea for RBI to lower the rates any further. And it goes on to say this is especially given that inflation has been greater than 6% for several months now, and supply constraints are unlikely to get relaxed anytime soon. Actually, I might just add to that just another factoid. I mean, I just looked up, you know, the RBI's website to look at their liquidity injections since March, and probably you're all aware of this, but what caught my eye was that if you look at the period between what is it, sort of end of February or beginning of March to the 6th of September. Yeah, between March 1st and September 6th. It turns out that there was actually net liquidity injection has been actually in the negative. And it's not a small amount. It's 65 trillion rupees over the 6-month period. And that's because while there is a liquidity injection of about 3.1 trillion, basically it's leading to excess reserves with the banking system. And the banking system is really parking its reserves back with the RBI through the reverse repo operations and even minor sales of government securities. And that's about 68 trillion rupees worth of reverse repo operations. So I mean, this begs the question of, you know, reinforcing that last question, has monetary policy basically run its course? And so going back to some of the themes that all of you talked about. So maybe we perhaps go with Ashima, perhaps Pranav and Montek, I'll give you the last word, if that's all right.
Yeah, I think that it's a very narrow view of monetary policy to say that it's restricted to the interest rate, because you know, these credit, for example, we're seeing a revival of the corporate bond market, although credit per se has not increased that much, but under the risk warranty it has. So I think this excess liquid, but I really believe in balance, so you do not go to the other extreme. But I think this common view, and as the figures you have given are absolutely correct, that the RBI is creating so much liquidity, it can create problems. It does not create problems because it's absorbed in reverse repos. It's not just floating around. Although it does probably lead to an increase in stock market prices, the asset prices in general. But on inflation, I would say that this wholesale price and consumer, this is a problem that all through the 2010s, it really troubled us. That was the reason there was this absolute collapse in public investment, because firms were facing really high real rates because wholesale prices were low and the RBI moved to target consumer price inflation. I agree with Pranav. But I think the problem today is a little more temporary, because if you look at that food prices, it's much higher in the CPI than it is in the WPI because of retail bottlenecks, lockdown related, the transport restrictions we have seen. So the current, you know, this gap between the prices that are relevant for firms and for consumers might be more short-lived. And my own view is that the RBI should look through these and continue with an accommodative stance, because, but India has a sort of zero bound. Actually, there's not enough time to go into that, needs a full session on its own. But currently, internationally, there's this view of a dual interest rate policy. You know, I mean, you support both firms as well as consumers, using the reverse repo to help firms give higher deposit rates to firms, and long-term targeted TLTRO to help firms get lower interest rates. So there are a lot of instruments that monetary policy has available that it can use, and we have used it very, very limited way in India. We went to the opposite extreme, and the rest of the world was doing QE, so there's more we can do. I agree with Montek about the necessity to raise taxes, but not now when you need to stimulate demand. And just leaving him with a question, what do you think about taxing agriculturalists? Already we have seen the rich farmers protesting in Punjab and Haryana, but that is a huge chunk of Indian income which is just out of the tax net, and it is a huge source of leakage from taxation, because, so isn't it time to look at that? Then Atmanirbhar, I agree totally that it's actually about strength and compete. It's very different from an import substitution mindset. It's about increasing exports. I think that's what Japan did, that to compete with the rest of the world, you have to become efficient. So hopefully it's not about import substitution. Then public sector banks, here I disagree with Montek slightly, because I'm on the board of one and I just joined in order to see what's happening inside. And I can assure him, at least on that bank and more generally, there's huge increase in governance. There's no interference with the boards. There's a move towards risk-based lending. I believe we had Yes Bank that collapsed. So we need diversity. It's the safest thing in the in any financial sector. Private banks all do the same thing. They all lend to retail, and there's concentration risk in that. There's nobody who's lending to SMEs. If you ask, I was talking to some Bank of America person, I'm saying, why don't you lend if public sector banks have NPLs? No. Public sector banks have always taken the lead in development. My own view is that we need to set up a development bank. Closing that was a big mistake, because that asset liability mismatch problems. So I think India, the way we have to grow, given our population, we need both. There's room for both public, private markets, corporate, because the problem was it was too much discretionary allocation by politicians. So there is that hands off now, but you need to make sure that, I agree that government ownership should go below, because the CAG should not be sitting on banks' decisions. There's been some reform in that also. The Prevention of Corruption Act has been moderated and so on. So a lot of changes are happening, and I think we are moving in the right direction. And we can't help something like COVID, but some that will help us maybe move further, quicker, and do more in terms of the reforms required for and changes required for sustainable long-term growth. Thank you.
Gaurav, can I intervene at this point and request Prabhup to let me have my 2 bits worth, because I have to leave.
Sure.
So if I can do that, I'm sorry. Look, I'm glad to hear what Ashima said. I want to clarify. I mean, I do agree that lots of things are happening. So I think nobody is taking the view that nothing is happening. And I'm really glad that her assessment of the bank on which she's a member of the board is doing quite well. A reference was made to Yes Bank, and of course there are egregious mistakes being made by private sector banks. The difference is that Yes Bank chairman was fired. The public sector banks have a huge amount, much the largest amount of NPAs, and no public sector bank chairman has actually been removed. So the signals that we give by not having the RBI having a balanced, equal capability in regulating public sector banks is a big problem. And I think for that, you need to get government share of the public sector banks to go down. And we can still have Ashima on the board representing the government. So that's not a problem. One final point, somebody said something about would UBI have been better? The original recommendation for the universal basic income was that we replace a lot of the existing subsidies with the UBI, and this was during a period when growth was booming. I certainly agree that if we had done that and we had brought in a UBI, it would have made things a lot easier. But I do not agree, since we didn't do that, there was no willingness to give up these other subsidies. I don't think we could have added a UBI in addition. I certainly don't agree that in the middle of a crisis, when you have a serious fiscal strain looming, that you add on a UBI. I think you do what the government is trying to do now, identify the schemes that are aimed at the poor, and for the next quarter or 2 quarters, try to expand them. As and when we get back to high growth, if we can substitute dysfunctional subsidies with the UBI, that's a separate discussion that should be had. Well, thank you very much for including me in the panel. I've really enjoyed it. Thank you. And allow me to leave at this point.
Yes, so thanks a lot, Montek. We really appreciate you taking the time. I know it was under difficult circumstances, so a special word of thanks and gratitude from our side for being part of the discussion.
Thank you. Thanks a lot.
Okay, thanks. Prabhup, we'll give you the last word, and then to try and bring this very interesting and lively discussion to perhaps a close, but over to you.
Well, yeah, as I think Ashima pointed out and as Montek agreed, lots of things are being done. And I think they should be done. But we also should be very careful about what we do with our expectations. You know, if you really look at the measures that the government has proposed, most of them are unobjectionable. The problem, of course, is a lot of them have been around for donkey's years. The government has moved very quickly on one or two of them, like on the farmers' bills of various kinds. This has been, on the cards for years, but they've actually done it. The point is that it has created a fresh round of apprehension. And in this kind of a situation, where the farm sector was doing well, the question that arises is that should such a step have been taken now? Because you are adding to the uncertainty in a category where the uncertainty was relatively low. So again, one fully agrees with everything that the government has proposed, but a lot of this is really dependent upon timing. And that's by and large a political decision. But the fact of it is that political decisions do have large and sometimes completely unpredictable economic consequences. And I think that even timings should be thought through a little carefully. This is true of a whole range of other things that the government has declared, in terms of, let's say, what you're going to do to the banking sector. But on the banking sector, for instance, the one thing I think we cannot hold back on indefinitely is an assurance of recapitalization. Up to now, the banking sector has borne the bulk of the burden of actually supporting the economy, however bad it may look. But the banks have really sort of held the fort for us. And I think a certain degree of assurance should be going out there, because I think the bankers are today feeling under siege. And I know Ashima is on a bank board. I've been on bank boards before. And there is a very distinct siege mentality among the bankers I have talked with. And these need to be allayed. And I keep harping back that it's not so much, or it is, what you do, but also how you do it and how the messaging goes out. Because that ultimately affects the way people think and the way people react. And that's where my basic concerns lie at the moment.
Very quick. And actually, my own view is that recapitalization should have come along with the AQR, because when you're asking banks to make such huge provisions and you're not recapitalizing, then you're just they cannot be lending. But the problem was the IBC. You needed to, because it's the first time that the large lending went out to the private sector. That had to be in place. But today that constraint is not there. So I think the government has already announced recapitalization. And again, recapitalization is something through bonds that affects debt, but doesn't require current borrowing. So the government is, I think, ready to do this. I've already seen an announcement of 20,000 crores. They've said they will. So I think they are ready to do that and announce that. Timing, the problem with timing is never the right time. We've seen with agriculture, the right time never comes. Everything is never right. You have to that's why they say a crisis is the best time to reform.
Well, no. A crisis is a good time for everybody else. If you had done all the non-agricultural stuff, I would be right there with you. Here was agriculture the sole bright spot, and now you've got the farmers out on the streets. That's what I mean by bad timing. Had you done the reforms in the other sectors where people are down and out anyway, I think you would have been okay.
Well, we might, thank you, Pranav and Ashima. I mean, this is, probably continue much longer, but I'm a bit conscious of the time. I think all of you, I must thank you all, and Montek and Absentia for so clearly putting forth your different perspectives on, with some, fortunately with significant overlap, different perspectives on where next in terms of dealing with the economic shock that we are all facing in the economy. So, I reluctantly bring the proceedings to a close, as this has been, certainly personally for me, it's been a very interesting discussion and stimulating discussion. But part of the hope here is also to provide yet another platform for having these discussions, and we hope that this has been one of them. And also in terms of our audience, my thanks to them for participating, and we would certainly be encouraging them to continue this discussion through other channels and other fora. So with that, let me once again thank all our speakers, and we were very lucky to have them, and they've been very generous with their time. So thank you very much, and we hope to continue this conversation in other platforms. Thank you again.
Thank you, Gaurav. I enjoyed it enormously.
Thank you, Prananda. Thank you, Ashima.
Thank you.
Thanks, Rasa.
Thank you, everyone. Yeah.
Very interesting. Yeah.
Thank you.